Good morning, mic check. You can hear me. Can you please type something? So good morning, everyone. Today is our 25th March morning webinar. So today we have Singapore Exchange update, geoenergy resources results, but unfortunately Guangzhou is not here. He won't be presenting on this. And we have US Weekly, US Pharmaceuticals, China Weekly, and China Strategy. Tara is also out on a meeting, so she won't be presenting on SREITS as well. So for Singapore Exchange update, so for the monthly statistical update for the month of January and February 2019, the DAV growth contracted 2.4% year-on-year and 1.4% year-on-year respectively. So this is rather low as compared to the 24.1% increase in second quarter 19, and this is for the month of October to December 18. So the contraction in derivatives volume is due to lower hedging activities as the markets recover. And we also cut our forecast for FY19 derivatives revenue growth from 27.4% to 22.1% year-on-year. So meanwhile, SDAV, as usual, it showed no signs of recovery and contracted 38.6% year-on-year in February. So for the recent events, we know that Hong Kong Exchange announced on 11 March 2019 its plan to launch the futures contract on MSCI China A index subject to the approvals. So currently SGX FTSE China A50 index futures is the only offshore futures contract tracking the China A shares market. So the impact on SGX for Hong Kong Exchange plans is that it puts them in a very vulnerable position. SGX derivatives business contributes to around 50% of total revenue in 6 months 2019, with the main driver being FTSE China A50 index futures. So this accounted for 43% of the total trading revenue, trading volume year to date. So it is inevitable that certain customers from SGX will make the switch to Hong Kong Exchange futures contracts. And SGX China A50 Index futures represents around 13% of total revenue as of second quarter 19. So assuming SGX were to lose 50% of its China A50 revenue, the impact to its PATMI will be around 8%. However, we do not expect Hong Kong Exchange plans to release their own futures contracts on the China A shares to have significant impact on SGX derivatives revenue in the short term, meaning for FY19 to 20. And this is because if Hong Kong Exchange were to obtain relevant approvals, the launch should be around November 2019. And secondly, if Hong Kong Exchange, it takes months for them to build up liquidity, and also it takes time to onboard the client systems. And thirdly, SGX derivatives platform provides a certain stickiness for customers, and it will also retain their customers to a certain high level as well. And this is due to the deep liquidity as their first mover. And secondly, they allow the customers to carry out margin offsets across their different asset classes. And thirdly, they also cater to the customers' needs to hedge currency exposures with their diverse range of currency pairs, including the USD to renminbi, as well as the INR to USD FX futures. So Hong Kong's exchange plans to release this new futures contract does not come as a surprise to SGX, and it's been in the works for the past 12 to 18 months. So their plans, in fact, it could also benefit SGX as their plans could create a larger ecosystem for the China A shares equity derivatives. And this could also deepen liquidity for SGX and increase volume for them with arbitrage between the exchanges. So our investment actions for this update report is we downgraded to accumulate. Previously, it was a buy at the lower target price of $8.17. Previously, it was $8.36. And the reduction in target price is due to our lower forecast for FY19 derivatives revenue growth because of the lower derivatives average volume growth for January and February, and not because of Hong Kong Exchange plans to launch the China A futures index. So the reduction in target price is due to our lower forecast for derivatives revenue growth in FY19 from 27.4% year-on-year to 22.1% year-on-year. And this resulted in a cut in our FY19 earnings by 2%, and resulting in a lower target price of $8.17. So because Guang Zhi is not here, I will move on to, Tara is not here as well. So I'll move on to US Weekly for Edmund.
All right, thank you, Min. So right now I'll cover the US Weekly. So for the US macro last week, one of the most important indicators was that the Fed signaled that they remain patient and leave the Fed funds rate unchanged between the 2.25 and 2.5% range. It is very unlikely for them to raise the interest rates for 2019. So the Fed also trimmed its 2019 forecast from 2.3 to 2.1 and its 2020 GDP forecast from 2% to 1.9%, which signals that, which sort of confirms that there's going to be a slowdown in the GDP growth rate for 2019. And they also mentioned that they're going to end the balance sheet runoff in September 2019, and that would result in the Fed being the net buyer of treasuries again. So that will provide them with the necessary ammunition if there's going to be a sharp slowdown in the economy. The manufacturing PMI also dropped to 52.5 as opposed to the consensus of 53.6 in March. So this is the lowest reading since June 2017. And this sort of confirms that there's a slowdown in the manufacturing for the manufacturing sector. But more of the positive news is that the existing home sales surged 11.8%, and this is the best gain since 2015. And this is mainly due to the low mortgage rate, along with positive consumer sentiments. As for the corporate news, Nike reported better than expected EPS, and revenue was, they missed the revenue expectations. So Nike is currently driving a digital strategy, And we believe that its brand momentum across geographies, especially China, will sustain growth for Nike. For the week ahead, some of the key indicators to be released will be the housing starts, the balance of trade, and the University of Michigan's consumer expectations. So this is the list of upcoming earnings release. So most of the earnings will be for banks in mid-April. All right, so right now I'll cover a bit about the US pharma sector. So we believe that there's going to be 3 leading therapeutic areas that will drive the top line growth for pharma in 2019. So the areas will be oncology, which is cancer, anti-infection, and endocrinology. So endocrinology is the study of hormones, treatments, which include diabetes. So this is confirmed by the Q4 2018 results. So the dominant therapeutic area will be oncology, which experienced a 44% year-on-year growth in 2018. And as you can see from the figure, there's a re-acceleration of growth from 2017 to 2018. We also believe that the prevalence of cancer, especially in the aging population, will drive demand for oncology. So the prevalence rate of cancer has been an increasing trend since 2027. It is expected to reach 1.71%, which means that by 2020, there will be about 5.7 million people in US that are surviving with cancer. The majority of cancers occur in those aged 50 and above. So about 88% of the known cases are from the elderly. So according to the US Census Bureau, the number of retirement age people will reach 22% of the total US population by 2030. And what this means is that the aging population, as the population ages, there will be greater and greater demand for oncology treatments. So this is confirmed by the pharma because if you look at its R&D pipeline, about 35% of the drugs that are currently undergoing clinical trials are for cancer, and it is at a 10-year high. Some of the negative news would be that there's a loss of exclusivity, which means that some of its patents are expiring in 2018 and 2019. So there are 212 billion sales at risk between 2019 and 2024, with 5% of the market sales at risk in 2019. Some of the key drugs that are going to expire will be AbbVie's Humira, Amgen's Sensipa, and Pfizer's Lyrica. So these are some very huge blockbuster drugs for these few companies. So although there's going to be biosimilar competition, but this is mainly for the Europe market, because in US, it is very much lagging behind. Until today, there's only about 12 biosimilars that have been approved by the FDA, which is the Food and Drug Administration. Despite the fact that there's going to be expiry of patents, they still have a favorable R&D pipeline to weather the LOE headwinds. So this is the list of the key blockbuster drugs and some of the late-stage pipelines that have shown favorable clinical trials. As you can see, most of its current blockbuster drugs are focused on oncology. Like for example, if you look at AbbVie, its Imbruvica drug, there's a 40% year-on-year growth for the past 3 years. Because currently both the Democrats and the Republicans are thinking of ways to regulate the pharma market, so it is very unlikely for them to raise the prices. And there's something called the co-pay accumulator programs, which is being implemented by the pharmacy benefit managers. So the PBMs are basically insurance companies. So this program shifts the copay coupons from pharma to the PBM, and the pharma has to pay more or to give more rebates to the patients so that they will be able to afford, or else they may switch to less expensive competitors. So although the sector is currently facing a patent cliff, we believe that the erosion of the legacy portfolio is likely to be very slow because of they're currently undergoing a lot of litigations to prevent generics from coming into the market. Also, they are also trying to explore small acquisitions, which will help to accelerate their research know-how. So we believe that the long-term prospects, along with its defensive nature, will remain attractive in this challenging environment. Our recommendation is that we are neutral on the pharma sector, and our preferred companies would be Eli Lilly and Merck & Co. Eli Lilly, we like Eli Lilly for its expanding pipeline and solid product launches. As for Merck, we like it because of its favorable margin expansion growth, along with its favorable Keytruda products. So right now, I'll pass on my time to Jie Yuan on the China strategy.
Thanks, Edmund. I will give the brief introductions about my report last week. China strategy, foreign capitals will continue to flow in. Firstly, the MSCI announced that it will increase the inclusion weight of the China A-shares from the 5% to 20% in 3 steps. The timeline schedules are May, August, and November 2019. And from the war previous observations that foreign capitals that typically will flow in 1 or 2 months in advance of the inclusion factors increased. And of course, it will bring about the 15 billion US dollars into the China A-shares market. Secondly, in 2019, the multiple index will include the China A-shares and RMB bond into their flagships index. This includes MSCI Emerging Market Index and FTS, FTSE's Emerging Market Index and S&P Index and the Bloomberg Index. This will bring about the 0.6 trillion RMB into the China market, accounting for almost half of the current positions. According to the Bloomberg, the China's exchange said in 3 years it will increase the financial asset held by overseas entities from the 2% for now, increased to 10%. So we are observing the foreign capitals will continue to flow in. As for the investment channels, we are seeing the QV quotas remain flat recently, and we are seeing after Shanghai Exchange increased the daily trading quotas of the Stock Connect. The Stock Connect usage quota usage being low, and they still have quite enough rooms for future investment. So we are thinking the Hong Kong Connects will be the main investment channels for the foreign investors. That's why we are overweighted on China A-shares, especially those A-shares can be traded through the Hong Kong and the Shanghai Shenzhen Stock Connect. For the ETF, the trade this kind of stocks are MSCI China A-share China A index and FTSE's the 15 index. These are few the ETFs that track those track those index. For China last week, for the two sessions of meetings, and I will issue a report about the summary about the two sessions of meetings this week. And for this week, we are waiting for the China government February profit rate of industrial enterprise to see whether the February is enough room data are benefit to the lowest kind of enterprise. Also, we are waiting for the 8 rounds of the China US stock decisions. This is a list of the stock recommendations from our Hong Kong research teams. That's all for today's webinars. If there are any questions.
Hi, so we have a question. So we have a suggestion on adding another column on the current price and potential upside. Yeah, thank you very much for the suggestion. We'll try to add that in. So regarding the next question on how to prevent generics from entering the market when the IP expires. So usually when the IP expires, the pharma will try to apply with the FDA to extend their patent. Sometimes it works, sometimes it don't. And usually they will try to employ litigation means to try to prevent the other generic companies from coming out with the biosimilars and the generics. And currently, one of the tactics that they are trying to employ is that they enter into private settlements with the generic companies. So what happens is that sometimes the generics will release the biosimilar or the generics for about 2 to 3 months. Then after that, there will be some litigation procedures which will end typically in a private settlement. So based on the settlement, the pharma have to, based on the settlement, the generics have to delay the genericization by, let's say, 2 to 3 years. And regarding the 3-month, 10-year yield curve inversion, we believe that yes, there's an inversion, but it by itself does not mean that there's going to be a recession. There's an imminent recession, because usually, based on the historical data, a yield curve inversion about more than 10 days will cause, after a yield curve inversion about in 10 days, usually there will be a recession within 2 years. But currently we still need to see whether this inversion will continue for this week or maybe next week. And even if it continues, it does not mean that there is going to be a recession within the next 6 months, because currently, based on the economic data, it is just that there's a slowing down of growth. There will be signs of trouble ahead, but we will need more data to show that there's gonna be a market crash.
The first is there will be three steps of the increased China Asia's inclusion factors. First, it will happen at the May 2019. It will increase the indexed inclusion factors of the 241 China A shares cap from the 5% to 10%. Second stage will be happened on August 2019. It will increase the inclusion weight from the 10% to 15%. Third stage will happen on November 2019. It will increase the inclusion factors from the 15% to 20%. On completion of the three steps, increase the inclusion weight, there will be the 253 large China A shares and 168 mid-cap China A shares and 27 China Next shares. If there's no more questions, we'll end today's webinar. Thank you.